You're scrolling through your feed, wondering how to finally start investing without feeling overwhelmed, right? Picture this, it's 2013, and a young college student is staring at the stock market charts on his laptop, frustrated and clueless. He wants to invest but doesn't know where to begin. Then, he stumbles upon a secret weapon used by top investors, a tool so simple, yet so powerful, it feels like cheating. Fast forward a decade, and that same student is now financially free, all thanks to one game-changing discovery, ETFs. What if I told you this isn't just a story, it's a roadmap you can follow? In the next few minutes, I'm going to reveal why ETFs are the easiest and smartest way to make big money in the market. No stress, no guesswork, just results. Stick around, because this could be the key to unlocking your financial future. Hey, I'm Brandon. If you're interested in investments or want to learn more, leave a like and subscribe to the channel so you don't miss any practical tips.
When you think about investing, one of the first things that comes to mind is often choosing a company you believe in, right? But what if you don't know which company to pick? This can be a daunting task, especially when you see news of companies dropping drastically in value, as happened during the 2008 financial crisis or the recent stock market turmoil of tech companies. How do you know which stock to buy, and when is the right time to buy it? What if suddenly you make the wrong choice? These fears are common, but the good news is that there's a way to invest without all that stress: ETFs. Here's the basic concept. ETFs, or exchange-traded funds, are investment funds that trade on the stock exchange, just like stocks. However, instead of buying a share in just one company, an ETF is like a basket that contains shares of many different companies. It's like going to the store and instead of picking just one fruit, you buy a basket full of different fruits. That way, if one fruit isn't good, the others can compensate. In the case of ETFs, the same principle applies to stocks. With an ETF, you don't need to pick just one company to invest in. Instead, you buy shares of a fund that already owns shares in multiple companies at once. For example, if you invest in an ETF that tracks the S&P 500 index, you are, in effect, investing in the 500 largest companies in the United States. This offers more diversification in your portfolio and reduces risk, as your money is not tied up in a single company or sector. How do ETFs help simplify investing? ETFs are popular because they offer a simple way to invest in multiple companies at once, without the need to pick each one individually. When you choose to invest in an ETF, you don't have to worry about analyzing each company on its own. Instead, you buy shares in a fund that already includes a selection of companies chosen by professional managers or that tracks well-known market indices like the S&P 500 or NASDAQ 100. The major advantage of this is that you gain access to a diversified portfolio of assets without needing to be an expert in finance. For those just starting out, this is a huge benefit. Additionally, many people simply don't have the time or desire to keep up with the performance of several different companies on a day-to-day basis. By investing in an ETF, you're essentially allowing professionals to make those selections for you, saving time and effort. Now, imagine not having to worry about that. You simply choose an ETF that fits your investment goals, and you are done. No need to research and analyze individual stocks or constantly monitor the market for changes. This level of convenience makes ETFs a powerful tool for beginners and seasoned investors alike.
Loving this content so far? Then, leave a like and subscribe to the channel for more tips. Keep watching, and let's dive deeper into why ETFs are so interesting.
Why are ETFs so interesting? ETFs are particularly interesting for two main reasons: diversification and lower risk. But let's dive deeper into how these factors work. Diversification is a key concept in investing, and it's often referred to as the golden rule of building a strong investment portfolio. Diversifying means that you don't put all your eggs in one basket. In other words, you don't invest all your money in a single company or sector. This helps spread out the risk, so if one company performs poorly, it won't impact your entire portfolio as severely. Think about it this way. Imagine you're Joao, a friend of Anna, who only decided to invest in Meta, formerly Facebook. He was excited about the potential growth of the company, especially after it transitioned into the metaverse. However, between 2021 and 2022, Meta's stock dropped by more than 70%. Joao was devastated because he had invested so much money into Meta's shares, and now his portfolio had taken a massive hit. Now, imagine if Joao had invested in an ETF instead of putting all his money into Meta. Let's say Joao had chosen an ETF like the SPY, which tracks the S&P 500 index. While Meta's stock had a significant drop during that time, the S&P 500 index only dropped by 15%. In other words, Joao's ETF investment would have been much less affected by the downturn of a single stock, because the S&P 500 represents a broad range of companies from various sectors. The impact of Meta's poor performance was diluted by the other companies that were still performing well, which helped protect Joao's investment. This is the power of diversification. When you invest in an ETF, you are essentially investing in the market's average performance, which helps shield you from the risks associated with any single company's performance. Even if one stock or sector is struggling, others may be thriving, which helps balance out your portfolio. Simplicity in investing with ETFs. In addition to diversification, one of the most attractive aspects of ETFs is their simplicity. Remember Anna? One of the things she loved most about ETFs was that she didn't need to be an expert to start investing. When you buy individual stocks, it's important to research and understand the history and performance of each company. For Anna, this seemed overwhelming because she didn't have the time to conduct all that research. With an ETF, Anna knew that professional managers or market indices were doing all the work for her in selecting the companies. All she had to do was choose an ETF that matched her investment goals, such as a fund focused on US companies or one focused on technology companies. By purchasing the ETF, Anna automatically diversified her investment and could trust that the companies chosen for the fund were balanced and well managed.
If you're enjoying this content, please consider leaving a like and subscribing to the channel. I promise to bring you the best information on the investment market. Stick around. I've got plenty more insights to share with you.
Another advantage of ETFs is their flexibility. Unlike mutual funds, which are bought or sold only at the end of the trading day, ETFs trade like stocks during market hours. This means that you can buy and sell shares at any time while the market is open, giving you more control over your investment. This level of flexibility allows you to adjust your portfolio in real time based on market conditions, news, or personal financial changes. Moreover, the composition of ETFs is transparent. If you invest in a fund, you can easily see a list of the companies included in that fund. For example, Anna can check exactly which companies are part of the ETF she's invested in, which gives her confidence and peace of mind about where her money is going. Types of ETFs for every investor profile. There are two primary types of ETFs: passive management and active management. Let's take a closer look at both. Passive management ETFs. These ETFs track a specific market index, such as the S&P 500, the NASDAQ 100, or the Dow Jones Industrial Average. These ETFs aim to replicate the performance of the index they follow. Passive ETFs are perfect for investors who want a simple, low-cost way to invest in the overall market. Examples of passive ETFs include SPY, which tracks the S&P 500, and IVV, another ETF that tracks the same index. Active management ETFs. Unlike passive ETFs, active management ETFs have portfolio managers who select the assets within the fund, aiming to outperform the market. One well-known example is the ARK Innovation ETF, which focuses on investing in disruptive technologies such as Tesla, Square, and other groundbreaking companies. While these ETFs can provide higher returns, they also carry higher risks because they're actively managed and rely on the skill of the managers to pick the right stocks. Diversification of choices for investors. One of the most appealing features of ETFs is their ability to diversify across various sectors and even international markets. If you believe that a particular sector, such as technology, healthcare, or energy, is going to experience growth, you can choose an ETF that is focused on that sector. This allows you to customize your portfolio according to your interests or financial goals. Additionally, ETFs can include other types of assets, such as commodities, like gold or silver, cryptocurrencies, and real estate. For example, if Anna is interested in investing in gold, she could choose a commodity-focused ETF that holds precious metals like gold and silver. Alternatively, if she's interested in cryptocurrencies, she could invest in an ETF that tracks digital currencies like Bitcoin or Ethereum. Costs and fees of ETFs. It's important to note that, like any investment, ETFs come with fees. Each ETF has an expense ratio, which is the annual fee charged by the fund to cover management costs and other expenses. These fees are typically low for passive ETFs but can vary depending on the fund and its complexity. Additionally, investors may also face brokerage fees when buying and selling ETFs, though many brokers offer commission-free trading for certain ETFs. Even though the fees may seem small, they can add up over time, especially for long-term investors. That's why it's a good idea to carefully assess the cost of the ETF and look for those with low expense ratios, particularly if you plan on holding the fund for a long time. Safety and efficiency in ETFs. When it comes to investing, safety is always a top priority. This is where the choice of fund manager becomes critical. Well-known, reputable fund management companies like BlackRock, Vanguard, State Street, and Invesco are some of the largest and most trusted names in the ETF world. These firms have decades of experience managing billions of dollars in assets, making them a reliable option for investors who want to ensure their money is in safe hands. By investing in ETFs managed by reputable firms, investors can be confident that they are making safe and informed decisions based on years of expertise.
Now that you know about ETFs and their advantages, I want to know. Which sector or market do you find most interesting to invest in? Comment below. I'd love to hear your thoughts and get the conversation going. If you have any questions, don't hesitate to ask. I'm here to help. Thank you for your attention, and see you next time.